Welcome back to the Daily Crypto Deep Dive, the show where we slow everything down, zoom out, and really get under the skin of the stories that move this market. Today, we're going to unpack something that, on the surface, looked like just another regulatory headline out of Asia. But if you look a little deeper, it tells you a lot about where power in crypto is actually shifting. I'm talking about the latest move from China's central bank, and the way it has hit stablecoin-linked stocks in Hong Kong, and what that means not just for traders in Asia, but for anyone listening to this show, wherever you are in the world. Before we get into it properly, big shout out to Lodovike99. They commented bringing up the importance of this story, so this one is for you. If you find these deep dives useful, make sure you're following the podcast and rate the show 5 stars wherever you're listening. Drop a quick done in the comments so we know you've jumped in. That gets you into the Friday XRP giveaway, and it genuinely helps push the show out to more people. The support over the last few weeks has been ridiculous, and it gives us the runway to keep doing long-form breakdowns like this every single day. So, let's start with what actually happened, in simple terms. Then we'll get into why it matters, why it hit Hong Kong so hard, why we deliberately held back some of this context during the worst of the sell-off, and how all of this quietly signals that the center of gravity in crypto is shifting away from being purely America-centric. The story, at the headline level, is this. China's central bank, the People's Bank of China, put out fresh language vowing to crack down on virtual currency activity and explicitly flagged concerns about stablecoins. That statement landed at the same time as a sharp sell-off in a cluster of Hong Kong-listed companies whose business models are tied, one way or another, to stablecoins and digital asset services. Names like Yunfeng Financial Group, Bright Smart Securities, OSL Group, all saw their shares slump, with some dropping close to 10% in a single session after the statement hit the wires. Now, that might sound like just another round of China FUD if you've been around this space for a few cycles. China bans crypto, then unbans it, then bans it again. We've all heard the memes. But this time, it's not about banning Bitcoin mining like in 2021, when China's regulators ordered a blanket halt to domestic crypto trading and mining activity. This time, it's about stablecoins, and it's about Hong Kong, which is supposed to be the crypto-friendly gateway next door. That combination is what makes this different. To really understand why, we need to step back for a second and talk about what Hong Kong has been trying to do over the last couple of years. After Beijing's full-on crypto ban on the mainland, Hong Kong started positioning itself as a regulated, controlled, but open hub for digital assets. They passed a virtual asset licensing regime, and more recently a stablecoin bill that created a framework for issuing and managing stablecoins under supervision. It attracted interest from exchanges, fintech firms, and even some traditional financial players who wanted Hong Kong to be the legal venue where Asia-based capital could still access the crypto ecosystem. So you had this strange dual reality. China officially banning crypto trading and mining, while Hong Kong, under the One Country, Two Systems banner, rolled out the red carpet, but with rules. That tension has been there all along. But for most of this year, the market treated it as an opportunity, not a risk. Hong Kong was the compromise. Beijing gets control. International capital gets a gateway. That's why this latest move from the PBOC hit so hard. The central bank didn't just repeat old lines about speculation. It specifically flagged stablecoins as a concern and vowed to crack down on virtual currency activity. And almost immediately you saw Hong Kong-listed stocks with stablecoin exposure getting smacked. Yunfeng down almost 10%, Bright Smart off around 7%, OSL losing over 4%. Not catastrophic, but a very clear message. And it's that message the market is reacting to. Beijing is reminding everyone that it can and will reach across the border and influence what Hong Kong does with digital assets, especially when those assets are stablecoins, which sit right at the intersection of money, regulation, and national control. Now here's where it connects to you as a listener, even if you've never traded a Hong Kong stock in your life. For years, almost the entire regulatory conversation in crypto has revolved around the United States. It's been the SEC, the CFTC, Gensler, ETF approvals, enforcement actions, and court cases. If you followed the headlines, you'd think nothing matters unless it comes out of Washington or New York. But what slowly started to happen this year and this Hong Kong story is a perfect example, is that the axis of influence is tilting. Asia isn't just a side note anymore, it's setting the tone. Think about how the trading day actually flows. The first real liquidity for Bitcoin, Ethereum, and major altcoins doesn't come from New York. It comes from Asia, Hong Kong, Singapore, Tokyo, Seoul. Those early hours decide whether Bitcoin wakes up heavy or light, whether there's appetite or caution. And what fuels that early session activity? Stablecoins. Tether, USDC, regional quasi-stable structures, and bankled fiat rails. So when the People's Bank of China steps out and explicitly says it's going to crack down on virtual currency activity and that it's worried about stablecoins, you immediately get trading desks pulling risk back in Asia. Order books thin out, market makers widen spreads. Institutions that were comfortable running stablecoin exposure through Hong Kong suddenly have to ask themselves whether they're still swimming in a safe lane, or whether they're about to be in the crosshairs of a regulator that does not mess around. That's not a US story. That's an Asia story. And this time, Asia moved first. There's a quote floating around from a CAIA-certified analyst commenting on the PBOC stance, saying the stablecoin crackdown addresses real systemic risks, while warning that Hong Kong's licensing regime can create regulatory arbitrage that undermines mainland controls. That's a polite, professional way of saying, Beijing is worried that Hong Kong's crypto experiment is leaking risk back into the mainland. Stablecoins are the pipe. And when the plumber doesn't like the pipe, he doesn't argue with it. He replaces it, narrows it, or shuts it off. So what does all of that mean going forward? First, it means that early session liquidity in crypto is likely to stay more sensitive for a while. We already saw how this played out during the recent sell-off. Thin liquidity, plus macro stress, plus regulatory noise, can turn a normal dip into an exaggerated move. If trading desks in Hong Kong and on the mainland are more cautious about how they use and hold stablecoins, those books will naturally get lighter. The result is simple. Smaller headlines lead to bigger moves, especially overnight, when the West is asleep. Second, it means cross-border stablecoin flows between Hong Kong, Singapore, Japan, and offshore entities are going to face more scrutiny from risk teams. You might not see this on a public chart, but if you talk to anyone on the institutional side, they'll tell you, when regulators start naming a product specifically, compliance departments go from monitor to tighten very, very quickly. That usually means lower limits, shorter holding periods, more hedging, and sometimes just avoiding the product altogether, unless it's absolutely necessary. Third, it reinforces an important theme you're going to hear more and more over the next couple of years. The battle over stablecoins is not just about crypto, it's about monetary sovereignty. China has a digital yuan project, a central bank digital currency it can control, track, and issue under its own terms. It doesn't want offshore dollar-linked stablecoins becoming the de facto digital currency inside or around its borders. Hong Kong has been trying to design a regulated stablecoin regime that plays nicely with international capital while respecting Beijing's red lines. This PBOC move is Beijing effectively saying, those red lines are still there, and they are not negotiable. Now let's tie this back to something we've talked about a lot on this show. The idea that the market is slowly moving away from an America-only lens. This week has been one of the clearest examples of that shift. On one side, you've got the United States doing what everyone expected, approving more ETF products, expanding access. We've seen Vanguard, which for years refused to touch crypto, finally open its platform to let clients buy regulated crypto ETFs and funds linked to Bitcoin, Ethereum, XRP, and Solana. That's a big deal, because Vanguard serves more than 50 million investors and manages around $11 trillion in assets. It's a clear sign that the US is slowly normalizing crypto access for mainstream portfolios. But at the exact same time, over in Asia, you've got the PBOC saying, we are cracking down, we're worried about stablecoins, and by the way, look what happens to your stock price if your business is too tied to them. Hong Kong stablecoin-linked stocks fell sharply the moment that language hit. So on one side of the world, access is widening. On the other, the rails that route liquidity through Asia are being squeezed. That contrast is the real deep dive story here. For a long time, the big question in crypto was, what will the SEC do? Would it approve a spot ETF? Would it class this or that token as a security? Could Coinbase survive regulation? Now, those questions still matter. A lot. But increasingly, we're seeing days where what happens in Tokyo, Hong Kong, or Beijing has as much, if not more, impact on the short-term direction of the market as any speech from an American regulator. You saw that with the Japanese bond auction that calmed global yields and triggered a risk-on turn across equities and crypto. You're seeing it again with the PBOC stablecoin stance impacting Hong Kong stocks and early session liquidity. Asia isn't just reacting to what the US does anymore, it's writing its own script, and global markets are having to read it. This is where I want to pause and talk directly to you as a listener, as someone with a portfolio in this space. If you're holding Bitcoin, Ethereum, XRP, Solana, or any of the majors, this doesn't mean you panic. It doesn't mean you suddenly tear your strategy up because of one statement from the PBOC. What it does mean is that you need to start thinking about regulation risk and liquidity risk as global, not local. It is no longer enough to only follow what the SEC is doing, or what Congress might pass, or what a US presidential candidate says about crypto. Those things matter, but they're just one part of the puzzle. Now you also have to watch. What is the PBOC saying about stablecoins and digital assets? What is Hong Kong doing with its licensing regime and its stablecoin bill? What is Japan doing with interest rates and bond yields that affect risk assets? What are South Korea and Singapore doing around exchange oversight? Because your portfolio might be denominated in dollars, pounds, or euros, but the books that move prices 24/7 are run from desks in every time zone. And Asia is becoming the first chapter of the daily story, not just a footnote. Now, let's talk stablecoins specifically. Stablecoins have become the oil of this machine. They grease everything: exchanges, DeFi, cross-exchange arbitrage, settlements between trading firms, yield strategies, lending desks. For years, the biggest fear people had around them was simple. Is the backing real? Did Tether actually have the reserves it claimed? Was USDC truly fully collateralized? Would a run on a stablecoin blow a hole in the market? Those questions haven't gone away. But what's creeping in now is a parallel fear. What if a regulator just decides to turn the tap off? In the US, that conversation has mostly focused on legislation. How to regulate stablecoin issuers like banks, how to supervise reserves, how to avoid another Terra-style collapse. In China, the conversation is different. There, the concern is not just about investor protection, it's about capital controls and currency sovereignty. A dollar-pegged stablecoin circulating in or around the Chinese economy is effectively a shadow version of the US dollar competing, in digital form, with the yuan and the future digital yuan. From Beijing's perspective, that's not just a product risk, that's a strategic threat. So when the PBOC says it's cracking down on virtual currencies and explicitly flags stablecoins, it's really saying, we don't want dollar-linked digital money dominating any part of our financial perimeter. And when Hong Kong stocks with stablecoin exposure sell off on the back of that, what you're seeing is the market internalizing that message and repricing the business models built around being that offshore gateway. Could this spill over into Tether, USDC, and other global stablecoins? In a direct sense, probably not immediately. They're not being banned worldwide because of this one statement. But in an indirect sense, this absolutely feeds into the broader debate regulators everywhere are having. How comfortable are we with private, dollar-linked digital money becoming a parallel system? In Europe, in the US, in Asia, you're seeing the same pattern. Regulators insisting on more control, more reporting, more limits. In that world, the Hong Kong episode isn't an isolated shock, it's a preview. It shows you what it looks like when a state that is very serious about capital control starts tightening the screws on the parts of the ecosystem it can reach. And here's where that shift away from an America-only focus really crystallizes. If you're only watching US politics, you might look at the last year and think, we're turning a corner. We've got spot Bitcoin and Ethereum ETFs. Now we've got giant asset managers like Vanguard finally letting people buy those ETFs on their platforms after years of refusing. You've got politicians courting the crypto vote. You've got court rulings setting some limits on what the SEC can do. From that vantage point, the story looks like one of gradual acceptance. So what does this actually mean for you in practical terms? First, it means you should start paying attention to where your stablecoins live. Not just which stablecoin you use, Tether, USDC, whatever, but which jurisdictions your platforms connect to, where those companies are regulated, and what kind of announcements from which central banks could affect them. If an exchange is heavily dependent on Hong Kong banking rails or Hong Kong regulatory permissions, then what happens in Beijing and Hong Kong matters a lot more to you than some random bill being debated in Washington. Second, it means you should expect more episodes where Asia moves the market before the West even wakes up. Drops that start with a Chinese statement, a Hong Kong regulatory tweak, a Japanese bond auction, and only get picked up by US commentators hours later. That can create opportunity if you understand the pattern, but it also creates risk if you're heavily leveraged and asleep when those announcements hit. If you've listened all the way through, thank you. Drop your thoughts in the comments. Do you think stablecoins will still be running on offshore rails in 5 years? Or will central bank digital currencies eat that market? Let me know. Rate the show 5 stars if you haven't already, it really does help. And make sure you're following so you don't miss tomorrow's roundup. As always, stay safe, stay curious, and we will see you at the top.